Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. Also, I'll just let you have a quick look at the disclaimer. I'll just run through what we hope to get through in the next 30 minutes or so. We'll follow the normal format, so we'll just check out how markets are trading currently, what is in the news over the weekend. Then we'll just check out a few themes that we've pinpointed and things going on really that are of interest, and we think we should just delve into in a little bit more detail. That includes the VIX actually, so the volatility gauge, Wall Street's fear gauge, if you like, and just some thoughts on the August readings that we get, and a chart actually, and then we have a couple of charts around stocks. Magnificent 7 stock, and also a chart around expected volatility after earnings, quite interesting. We'll look at the US major indices, obviously close to or hit record highs, the NASDAQ especially, with the Mag 7 leading, so we'll just look at that. And then we'll get into last week's main event, which was the Bank of England meeting, and there were bits of data actually out of Canada, and also ISM services data out of the US early last week, which was really quite interesting for jobs data going forward in the US. Then we'll look at this week's main events, which are, of course, US CPI out tomorrow. We have an RBA meeting as well, due to cut rates after their surprise pause last time around. Bits of UK data as well. So a lot to get through. Yeah, please do ask any questions along the way if you do have any in the box, and I'll try and answer those as best I can. Otherwise, first up, APAC stocks mostly in the green, gains limited in the absence of sort of major catalysts, of course, over the weekend. Japan actually away from the market. President Trump, he said he'll meet Russian President Putin on Friday in Alaska. And the White House apparently is considering inviting Ukraine President Zelensky. On the Fed side, Bauman of Otis said that the latest jobs data reinforces her forecast for 3 rate cuts this year. Interesting on the Fed chair list, prospective Fed chair list, if you like, post Powell stepping down in May next year. Wall Street Journal apparently now includes president of the St. Louis Fed, actually Bullard, on the list, as well as a former George W. Bush advisor as well. Now, interesting that, although clear favorite, I think, still is Hassett. And then Waller, of course, Waller being the clear favourite now, and then Hassett amongst the two Kevins. European equities mixed. European stock futures, 50 stock futures, relatively flat. I think last time I looked, cash, that comes after cash gain actually on Friday, 0.3%. Dollar a touch, flat really, pretty much. Actually was a touch softer. Euro marginally outperforming was. And gold noticeably down over 1%. Actually, traders are waiting clarification really from the White House over its tariff policy. Basically, confusion reigned on Friday after a government agency in the US basically stunned the market by formally ruling that COMEX accepted size bars would be subject to tariffs. And there was a load of physical moving between Switzerland, London, New York. So yes, just confusion at the moment in the gold market, the physical gold market, really. Just briefly then, a couple of thoughts on what's been happening. There's the US-Russia summit, as I mentioned. Pretty much the consensus of political analysts, really, and most media reports suggest Putin is willing to agree to a ceasefire, but only with substantial territorial concessions from Ukraine. And we've heard that from President Trump, talking about sort of switching land, which isn't really what Ukraine wants to happen at all. Of course, President Trump's main leverage is probably the threat of sanctions on Russia and protectionism pressure, really, on Russia's trading partners, really, and we've seen that with India and oil. The extent to which Russia's economic slowdown might compel concessions, or how far Trump is willing to push for a favourable territorial settlement, of course, remains uncertain. So, yeah, a lot of things really up in the air still. The absence, of course, of any Ukrainian or European representation at the summit as well probably suggests any agreement reached on Friday should be only preliminary at best. Of course, any kind of ceasefire, you probably get euro upside, certainly against the dollar, the yen, and the Swiss franc, really. But nothing major, probably, as it's kind of what people are hoping for and the market are hoping for anyway. Just moving on from that, then, interesting last week, Trump nominated Stephen Mirren for the temporary position on the Fed board to serve until the end of January. That's filling the remaining term of the recently vacated seat. Just for your guide, Mirren, well, he's the architect of the Mar-a-Lago paper on the dollar. He's expressed skepticism about the Fed's independence and has argued for stronger presidential control over the Fed board. He's essentially a dove, of course, a proponent of a weaker dollar. And it's interesting actually. His nomination sort of led to a marginal decline in USD, nothing major on Friday, but really markets are anticipating the potential alignment with Trump's policy or push for looser monetary policy, I should say. So somebody will take over from him in January. We've highlighted that before. That is likely to be a dove, or likely to be actually then the next Fed chair in May once Powell steps down. But dovish side to it, the appointee of Mirren, and then going forward, of course, that appointee in February onwards. So potential impact, of course, politicalization of the Fed possibly, but also then, which is what happens actually. We should say that in other countries, other central banks, you do get appointees who are more pro the government policy of the time, really. And we've seen that in the Bank of England, we've seen that in the Bank of Japan as well, actually. So let's not forget that in amongst obviously these big headlines about who gets appointed and at what point in time on the Fed, on the FOMC board. Moving on from that, I just want to show you a chart about the VIX. Yeah, August really, and I wrote about this of sorts briefly in the introduction to the week ahead this week. Actually, just about the middle of August being summer markets, generally a quite dull period. Although you do get sometimes price action, which leaves you scratching your head. Certainly leaves me scratching my head, just because of thin liquidity. A lot of lawmakers, central bankers are on a holiday as well. Obviously, big trading desks manned by junior staff, really, as most other people are on sort of some kind of holiday. That said, August, and this chart shows you, is when volatility has a habit of basically exploding. And last year, I wrote about that, and the week ahead was a case in point. We saw a sharp rise in the yen combined with a drop in US tech stocks, really. That saw the biggest one-day burst in volatility on near record, actually, start of August last year, and there was question marks about then the yen carry trade that was. So you can just see on this chart, yeah, August has the most volatility across all the different months. The average percentage move over the last 35 years actually is around 0.56%, which is the highest for any month. The least volatile is April, even with actually this year's meltdown after, of course, Liberation Day. At the start of April, that average move is around 0.07%. This is on the VIX, of course. Wall Street's fear gauge, which is a volatility index basically of options prices on the S&P 500 out to 30 days. So yeah, just of interest there, whether we just see any kind of pickup in vol. Due to sort of summer markets and being stuck in August and the lull, could be for any random reason, really, or a very short-lived reason. Before then, we get back into September, and when volumes at least pick up. We do have, of course, next week's Jackson Hole conference. So that is the FOMC symposium. Every year they meet central bankers at Wyoming, I think it is, in the US, Jackson Hole. And potentially there is a shift in monetary policy signaled at that conference, basically. So focus will turn to that by probably the end of the week this week, and whether we do see a dovish shift of some kind or not from Chair Powell. Otherwise, then, moving on from that, earnings drawing to a close really now, the Q2 season. Interesting, if I just pull up this chart, actually, first of all, it's from Goldman Sachs. And they just note that the average post-earnings move for S&P 500 constituents exceeded the options implied expectations for the first time in at least 18 years. So, yeah, just to explain this again, sometimes, and I think we've previewed some of the Mag 7 and just checked out what options are pricing for the move after the release of earnings, sort of 5, 6, 7% in some cases for some of the Mag 7. That's what's expected. But in this year, actually, and this is for all the constituents that we have seen, actually, not just the Mag 7, as I say, options implied expectations for the first time. Real percentage moves, actually, the average has exceeded those options implied expectations. First time in many years, 18 years, and that's kind of a sign of upside surprise outpacing market pricing. You can just see the implied move there, and then the darker blue line, actually the realized move. So very rare for that to be the realized move higher than the implied move, and you can see that going back for some time. So again, stocks have moved around over 5% plus or minus on average during this quarter of earnings. That is again the highest in 15 years on a like-for-like basis. So yeah, just an interesting chart we thought there, and something we will highlight going forward in the video results. Actually, we'll try and bring you those option implied prices as well, and what they expect post the release of those earnings, which would be obviously the day later, because Nvidia releases after the US closing bell. Otherwise, back to the other chart I had, which was Mag 7 earnings, actually, and just showing you really how strong these earnings, compared to then the 493 other stocks on the S&P 500. So again, apologies, light blue line and slightly different blue line to the right of the big bar. The big bars are, of course, Mag 7, and then you can just see, well, this is out to 26. So be careful of those sort of estimates, but just sort of over the next couple of quarters, you can just see, and previous to that, obviously, how strong earnings growth from the Mag 7 has then driven really the index. At the moment, I think they are around those seven stocks, 32%. So 30, yeah, a third of the S&P 500 market cap at the moment, roughly. I think they're 23% of aggregate forward earnings and 12% of aggregate forward revenues. And even amongst the Mag 7, actually, it's really only three stocks, M, N, and M. M, N, and M, that is, yeah, which are, of course, Microsoft, Nvidia, and Meta, which are driving then the Mag 7, actually. Microsoft, I think, is up around 24%. Nvidia, 36% year to date. Meta, 31%. And that contrasts quite heavily then with the other stocks. Google, around, I think, 6%. Amazon, barely in the green, around 1.5% up year to date. And then you've got Apple down at over 8%. Tesla, obviously down around 18%. So just out of the Mag 7 at the moment, at least, only three of those stocks really driving, well, the broader index in a way. So just be careful of that. I know a lot of people mention and talk about the breadth in the index, but obviously it's driven these indices to record highs, but there are sometimes some warning signs around that. Otherwise, well, on Friday, Wall Street finished on a positive note. S&P gained 0.8%. NASDAQ rose almost 1% to another record high. Just checking futures, actually, they're up as well. Modestly, and the Dow as well added over 200 points. Tech, of course, driving all of this. Apple, interestingly, up over 4%, unveiled another, well, a huge US investment plan, hundreds of billions of dollars going into the US by all accounts. Obviously, the Fed rate cuts expectations are ramping up higher after that NFP report, the first Friday of this month. So, yes, as I say, Mag 7 leading the gains, And even if you look at, say, an equal weighted chart and the regular weighted S&P, you could just see that diverging basically, which is really highlighting what I'm saying, what I've just said over the last few minutes at least. Let's look quickly at those charts, although they're just kind of roofing, so I can't add too much, to be honest. Strong momentum. You can just see this pick up again after that sell-off. At the start of August, of course, so possibly we did get a small pickup in volatility. If I look at the VIX chart, yeah, you can just see we went above 20 to 21 on the first day, and then we come back down. Here's the VIX chart, yep, there. And then S&P, yeah, that dipped down, and then we're just slowly edging higher again, and bullish momentum picking up with that all-time high at 64.27 on the S&P. Nasdaq, we've broken that and we've closed strongly higher. We look at the week, you can just see, yeah, really interesting, because we wondered about this bearish engulfing candle basically at the start of the month, and potentially that sort of starting some sort of downside. Didn't happen, and a very strong closed on the highs for the week last week, which is very positive. And you can just see, yeah, that previous high at 23,573, and we closed at 23,611. That's the Nasdaq. Dow, interestingly, obviously still lagging. Different components in there. Less tech, of course, much less tech. More defensive stocks, so slightly lagging. Again, didn't have, well, there's a bearish engulfing, not quite, but in the S&P it was actually on a weekly. But anyway, yeah, found support of the 50-day moving average. That's now at 43,655, and then the all-time high just above 45,000, 45,054 on the Dow. Okay, let's move now to last week's main events. First up, we had the Bank of England meeting, of course. I kept this chart from last week, actually, because it's still their conundrum, really, for the Bank of England. They cut rates by 25 basis points, as expected. Now the base rate is at 4%, lowest level, actually, since March 2023. And it was a but, yes, big but, really. For the first time ever, actually, the MPC required a vote for a second time after they had a three-way split. In the first vote, 4 members, just for your guide, they voted to leave policy unchanged, 4 voted for a 25 basis point cut, and then 1 for a 50 basis point cut. So they had a second vote, 5 members wanting to ease policy, coalesced around a 25 basis point cut, basically. That created a majority, and the MPC cut rates. So exceptionally split, exceptional circumstances, really. First time ever, as I say. And really interesting, the minutes, basically, of the meeting revealed, well, of the statement, really, those favouring a cut were more concerned about disinflationary pressure from emerging slack in the labour market, revealed by kind of moderation in underlying wages. But the 4 members in the minority, they emphasised, well, a recent increase in headline inflation, and the disinflationary process had actually slowed, according to them, and the risk of inflation expectations feeding through to second round effect had risen. And it was interesting then, we had updated Bank of England projections, and for CPI, well, that illustrated the latter group that I've just mentioned really well. Headline inflation now expected to peak at 4% in September. That's 0.3 percentage points higher than the Bank of England expected just 3 months ago. Although then they expect a return to the 2% target a quarter later. So, yeah, really interesting hawkish cut, if you like. Obviously, lots of us talk about, what kind of cut it will be when it's fully priced in, pretty much, whether it's a dovish cut, a hawkish cut, or maybe neutral. But in this case, very much a hawkish cut. Really interesting, especially with those projections. Just for your guide, GDP, that was little change there. Forecast for growth, the MPC, and kind of consistent with a gradual recovery. And then in the press conference, Governor Bailey, he admitted that while the policy rate remains on a downward trajectory, the monetary policy path has become even more uncertain. With the committee attempting, obviously, to balance what we've been talking about actually through these webinars, balance upside inflation risks against concerns over economic growth and activity, and also then the labour market. That is the tough sort of balancing act conundrum the MPC faces. And at the moment, they kind of, cut rates, but the market as well has said we might not see any more rate cuts this year. Of course, there was still that maintaining of forward guidance being a gradual and careful approach to the further withdrawal of monetary policy restraint. That has meant quarterly rate cuts, which is what we've seen obviously so far. But as I say, markets after the Bank of England meeting really priced out more rate cuts for this year. Next one now, 25 basis points, not fully priced in till February next year, actually. And the November cut, I think, is around a 50-50 bet. So, yes, still issues around inflation, and that's why I've kept this chart in here, versus, of course, those downside risks around obviously growth and potentially the labour market easing. So, yeah, really interesting meeting. We just pull up cable, which is obviously sterling against the dollar. Just grab that chart, sorry, 1 second. Yeah, you can just see different channels really, upward channel, bullish channel for the most of this year. Then we got this move lower, down below 132, tapped on that 38.2 fib level actually at 131.40, and then decent bounce actually, consecutive days of gains. As we've had that repricing of the Bank of England, so repricing of the dovish cuts, and less cuts means a more attractive pound, basically, which is what we've seen against obviously the opposite in a way of the Fed and the dollar and the pricing of a dead certain really September rate cut from the FOMC. So yeah, really only going to get sterling going higher against the dollar in that circumstance. And we just sort of come to the top of this channel actually, which is interesting, and just pulled back slightly at the moment. We've still got in here this high from September of last year, which is at 134.34, and then you've got the top of that channel as well, which could act as resistance. Blue line, just for your guide, that's a 50-day moving average. So that's a 134.98. And just see how it works quite well as support. So possibly then now acting as resistance as we're below it. So watch out for that level. Otherwise, those two swing highs from late July, just below 136. And then you've got that multi-year high from the start of July at 137.84. Okay, otherwise, just briefly, actually, before we get to this week's main events, we did have that ISM services data out of the US. Important, really, I think, because it was lower than expected, still just above 50. But as with the manufacturing, was weaker than anyone surveyed had predicted. And as well, employment fell again. And that doesn't bode well for the August job report that we will get ahead of obviously the September FOMC meeting. Really given manufacturing employment, that dropped actually to the weakest level since June 2020. So if you kind of weight 90% for services, 10% for manufacturing, that really means we get non-farm payrolls below 100,000 for the next few months. And that's really what we should be braced for if these are any guide. They're slightly less they've worked less well since COVID and the pandemic, but still something to be aware of. On the flip side, prices paid for the services actually was the highest print since October 2022. Obviously down to near-term tariff worries and front-loading, that kind of thing. But I should say, going forward, got pretty benign energy prices. We've got cooling housing and wages pretty subdued. So possibly then that will cool some of those prices paid components for, well, services and actually manufacturing ISM. Sorry, just before we get to this week's main event, sorry, just one other bit of data, and I'll just pull up the dollar CAD chart because we had Canadian jobs data out on Friday. Pretty important number. because Canada lost 41,000 jobs, pretty much rounded up in July. Biggest net job losses since actually January 2022, and that was versus a consensus reading of around plus 10,000. So negative 41,000 print, 6.9% unemployment. Printed unchanged actually, but it does just prompt all these concerns over domestic demand. Underlying full-time employment levels, they remain very, very weak, and the participation rate dropped. For the Bank of Canada, they held rates, if you remember, at 2.75% at the end of last month, but Governor Macklem did express concerns over economic weakness throughout this second half. Business confidence, that remains subdued, and in contrast to June, actually consumer confidence has decreased in the past 3 months in response to heightened trade tensions, of course. At the moment, those trade tensions, well, there's a blanket 35% on tariffs on non-compliant exports, but Prime Minister Carney actually has said that around 85% of trade is actually tariff-free because of the USTMA agreement, of course. But you still have 25% tariffs remaining on autos and 50% on steel and aluminium. So this is a big uncertainty and a big worry for Canada, and really interesting, really bad print there. Although I should mention summer students as well may have something to do with it. But anyway, dollar CAD for your guide. Just see that downward trend line, but kind of found a base potentially around 136, just below 136, that low at 135.38, of course. But sort of we found, support just below 136 on a few occasions, and we've pushed up above that now. You've got the 50-day moving average that is, again, has acted as sort of resistance now, would be support. That's at 136.90. You've got that recent high from, month-to-date high from the start of August at 138.79. And then just above that, quite some way, that black line's a 200-day moving average, actually just above 140, 140.33. Okay, moving on to this week's main events. And first up, US CPI data, of course. And then we'll look at the RBA meeting as well. So here you've just got a chart with those key numbers. The headline currently at 2.7, core at 2.9, and then the benchmark rate at 4.25 to 4.5%. So the headline is expected, the monthly, to print at 0.3%, I think, previous 0.3, and the annual then rising a tick, actually, 1/10 to 2.8 from 2.7. The core rate, more importantly, expected to rise by 0.3% month on month from the previous 0.2, and then the annual reading is going from 2.9 actually currently to 3% expected. Data then, of course, is all about tariffs and higher tariffs pushing up prices potentially, though it kind of is still quite a touch early, really, in the price sort of adjustment process to see how these higher import taxes ultimately then are distributed between, obviously, the end customer, domestic sellers, and of course then foreign exporters as well. We have had sort of growing consumer fatigue, really, which is making it more difficult to raise prices in general as well. That should be noted. Markets will probably be watching the core goods prices number, excluding autos. That rose 0.6% month on month last time. Biggest monthly increase in that number since February 2022. So watch out for autos, because they didn't really impact prices last time around, although they are impacted by tariffs. So that'll be interesting. But then on the flip side, you do have sort of cooling housing rents, which could then possibly offset the tariff impact in the months ahead. So that's the CPI data. Fed officials, they're kind of, well, some are more concerned about the labour market. We know Waller, Bowman, as we've said, but then others still believe inflation is further away from the Fed's goals. High inflation, fears of higher inflation ahead in response to tariffs, of course, is then obviously seeing that wait and see approach, although obviously markets have moved ahead with that employment net data, as we've said. Pretty much it's getting on for fully priced, really, the September meeting. In fact, we haven't pulled up the CME Fed Watch tool for a while. Just bear with me 1 second. and I'll just pull this up. This is basically a tool of futures pricing of by the Fed meetings. Actually, really useful tool. So it just prices what futures are telling us, Fed fund futures, for the precise date and that Fed meeting. So hopefully you can see this Fed Watch tool. It's called the CME Group, who are the biggest futures exchange in the world. They compile this really useful tool, and you can see current target rate 4.25%, 4.5%. So there's an 86% chance. I think I said 90, 86% chance of a cut at that September meeting. Scroll down, you can see just a month ago that was sort of nearly 50-50, just above 50-50 for a cut. So you can just see how it's moved a lot. And then you can go to other meetings. So the October meeting. So if we do get that cut, then the chances of another cut's pretty high, just above a coin toss, 55% or so. And then December, whether we get a cut, then another cut on top of that, which is again pretty high chances of that happening. So 3 25 basis point cuts, more or less, priced in, at least 2.5, against, of course, what we have seen previously. So do check out that website, really useful, CME Fed Watch tool for your guide. Otherwise, moving on from CPI data, we do have retail sales actually on Friday out of the US. Pretty important gauge for consumer strength, of course. Expectations are for a headline print, positive headline print, 0.5%. That would mean back-to-back rises, actually. But demand doubts, of course, do remain with obviously trade policy uncertainty, though, of course, lower interest rates could offset some of those concerns. Let's just pull up the DXY chart now, actually. So this is the dollar index chart. Bear with me 1 second, and you can just see how we're pretty flat today, moderately higher today. You can see the blue line again acted as resistance. That's now support potentially. That's the 50-day moving average at 98.18. Then again, we've got a swing low from way back actually in July 2023. That's at 99.57, which kind of capped the upside on a couple of occasions. You can see there. So that'll be interesting, along with the minor fib level as well of this move lower. That's at 99.63. Dotted line, just for your guide, that big dotted line there. If I just pull back to the monthly chart, you can see the lows from June 11, then June 2021, and at the moment holding those lows, those recent multi-year lows that we saw at 96.37 at the start of July. So yeah, interesting chart on the DXY. Okay, that's the US data. Let's move on to the RBA meeting now. Happens overnight, UK time, obviously Tuesday, happening tomorrow. Likely to cut the RBA by 25 basis points, taking the rate to 3.6%. Just got a chart in here which just shows you there hasn't been much change really in the difference in what's being priced by the market. Yeah, this rate cut is fully priced. Just as a reminder, and as I mentioned, the RBA did surprise last meeting. They paused on rates amid wide expectations for a cut, saying the board will be attentive to data and, of course, evolving assessments of risks to guide their decision. Really, yeah, that was the key point. They wanted more data to confirm inflation was on track to reach 2.5% on a sustainable basis. That's also what Governor Bullock said in her press conference. But she said she was confident they are on a path to ease further, although obviously questions around the timing. And since then, we haven't had a lot of language from the central bankers really to shift that dial, but data releases really have confirmed or support a cut at this meeting. We've had disappointing jobs data, which showed the unemployment rate actually unexpectedly rose in June, highest level now in 3.5 years at 4.3% from 4.1%. And then jobs-wise, only added 2,000 jobs versus a 20,000 consensus estimate, while inflation as well continued to soften in Q2. Headline easing in June, coming at 1.9%, and the trimmed mean CPI that fell to 2.1%. And then on a quarterly basis, actually, just for your guide, headline inflation that moderated 2.1 from 2.4 in the first quarter. And that really does cement this rate cut for this meeting. You can just see now terminal rate is around just above 3%, around 3.1% for that sort of end rate in 2026, with more cuts potentially coming this year as well. I think there's around 60 basis points for your guide of rate cuts priced in by this year end. And then obviously that includes 25 tomorrow, and then another 25 for sure. And then around a 40% chance really that we get a third one if you go with the 50 basis points priced in total by year end. So yeah, will be an interesting meeting. What they say about guidance and whether then they pinpoint sort of November, or if they're more dovish, then possibly another rate cut in September. Will be interesting. Just for your guide as well, we do get employment data out on Thursday, actually out for Australia. Expectations, just for your guide, actually for recovery in that employment growth to 25,000 or so after those flat prints really that we saw May and June. Unemployment that's forecast at 4.2% after jumping to 4.3 in June. Just let's pull up the Aussie dollar chart then, which is here. So you can just see, let's pull it back a touch. We're now just on the blue line, 50-day moving average, 65.16. We got the recent high at 66.25. We just sort of found support at the halfway point of this move lower. That was at 64.27. And then the black line just below that is a 200-day moving average of 63.88. So midpoint of this recent range. Interesting whether we get a decisive move up or down. Hugely dependent on guidance and what they tell us or what they think may happen going forward. And that's, as I say, that next rate move, November or September. Finally, I'm going to put up the euro sterling chart actually, because we do have a bit of UK data actually. Jobs report out tomorrow, always important. Wage growth numbers always important, and payrolls expectations. Unemployment to hold steady actually at 4.7, but bonuses still stuck at 5%. That's earnings ex bonuses stuck at 5%. Would be below the MPC's Q2 forecast of 5.2, but still sticky, elevated really. As we sort of mentioned, MPC was increasingly focused on the loosening in the labour markets, but now sort of absence any kind of major deterioration in this set of numbers. The voting split, of course, that we talked about, that suggests really the stubbornness of inflation could limit those easing plans by the Bank of England. As I mentioned, rate cut not fully priced in until next year now. Will be interesting though with these with this data. Wage growth again important and being sticky, being the issue for the MPC. We do get June month-on-month GDP as well. Actually, UK GDP out on Thursday. I expected to print just mildly positive after the negative 0.1 print last time around. Q on Q will be positive as well, just about 0.1 from 0.7%. Of course, that first quarter was boosted by front-loading exports ahead of US tariffs. And the annual growth rate, well, that could be a touch higher than the OBR's 1% estimate, which would be interesting for the Chancellor. Euro sterling, I've just picked this because it's certainly quite dependent really on UK data at the moment. If the market keeps pricing out Bank of England cuts, then obviously this would move lower. We've got first support around 86.31 there. And then you've got the 50-day moving average at 85.95. Of course, that is if markets keep pricing out Bank of England cuts. Otherwise, if that easing is still there or thereabouts of sorts, and as well, euro strength sort of picks up, possibly on a ceasefire, that kind of thing, slightly more than the sterling, then you'd look for more upside, of course, and that recent high is at 87.52. that spike high from April at 87.37. Okay, we will wrap it up there. I don't see any questions, just checking to see if there's any questions, but I don't see any at the moment. Really do hope that's proved of use to you guys. Really do appreciate you as well being on the call for 40 minutes or so. Please do follow us on social media. And also, we do put out a daily commentary after the US close. Every day has a look at the dollar, US stocks, a chart of the day, and also a look at the day ahead in a little bit more detail. Thanks so much again, and please do tune in same time next week. And take care out there.